You're making more money than you ever have. The promotions happened, the raises came, and on paper, your finances look exactly right. Yet there is a quiet, nagging feeling that the math doesn't add up, and you aren't actually building wealth the way you should be. This chart visualizes a staggering statistical anomaly. Roughly 40% of Americans earning over $500,000 a year report that they are still living paycheck to paycheck. Their fixed costs simply expand to consume their entire massive income. Generational wealth is rarely destroyed by massive, catastrophic market crashes. It is lost in the quiet, in-between moments. It vanishes through a slow accumulation of daily choices that look like normal life and feel like progress. Managing a top 1% income requires a specific mathematical equation. To actually keep the money you make, you have to identify the 7 invisible variables quietly draining your net worth. The first is the lifestyle creep and identity trap. When you start earning real money, your brain subtly redefines what normal looks like. You upgrade your apartment, you get a slightly nicer car. Individually, these feel like reasonable decisions, but they slowly fuse with your identity. Once that happens, cutting back feels like self-betrayal. This pie chart breaks down a rigid mathematical defense against lifestyle creep, the 75-15-10 plan. To ensure your savings rate scales before your lifestyle does, you live on a maximum of 75%, invest a minimum of 15%, and save 10%. Next is the overconfidence and ego trap. In a roaring bull market, almost everyone looks like a financial genius. If you make lucky investments early on, your brain records it as skill, leading to a cognitive bias known as the illusion of control. This bias directly fuels overconcentration, holding far too much of your wealth in one single asset. Think back to the dot-com bubble. When a massive bet makes you money quickly, you develop an emotional attachment to it, and that concentration becomes a point of pride. Companies like Intel hit massive all-time highs in the year 2000. Decades later, they still haven't recovered to those exact peaks. Placing massive bets on a single outcome carries extreme risk. Most portfolio managers enforce a strict rule that no single stock should ever exceed 5 to 10% of your total portfolio. Early success is not a reason to double down. Then we have the invisible tax and complexity leak. For most high earners, taxes are the single largest expense in their lifetime, larger than housing, cars, or food. Yet most people spend more time optimizing their streaming subscriptions than their tax strategies. Holding high dividend stocks in a standard taxable brokerage account instead of a tax-sheltered Roth IRA creates a constant wealth leak. You owe taxes on those dividends every single year, bleeding away the returns. This stacked chart illustrates the illiquidity trap. For households with a net worth between $1 and $2 million, about 66% of their wealth is typically tied up in their primary home and their retirement accounts. This leaves them dangerously short on accessible cash. This vulnerability is often fueled by buying the biggest house the bank will approve. A mortgage approval serves as an assessment of minimum payment capability rather than a recommendation for your financial strategy. Once you factor in property taxes, insurance, and maintenance, you might actually be spending up to 50% of your income on housing alone. If an incredible investment opportunity arises, or if an emergency strikes, you can't just liquidate your house in a week. To maintain true financial flexibility, total housing costs should never exceed 28 to 30% of your income. Trap 5 is financing friends and family. As you become wealthier, you naturally become the person your loved ones go to when they need capital. Because you are an empathetic person, you want to help. But roughly half of all new businesses fail within 5 years. Startups funded by friends and family often perform even worse because the investors are too afraid to ask the hard questions necessary to uncover fundamental flaws in the business model. We also have the trap of delaying and avoiding. People lose hundreds of thousands of dollars simply by putting off basic, unglamorous financial tasks because the paperwork feels cognitively annoying. This visualization maps out 2 distinct financial outcomes. Refinancing a mortgage feels tedious, so you let a $400,000 loan sit on autopilot at 7%. Dropping that to a 5.5% rate saves you roughly $900 a month. As this exponential growth line shows, if invested, that savings compounds into over $500,000 across 20 years. That is massive wealth lost simply because a task felt unpleasant. These administrative oversights drain your net worth as effectively as a sustained market correction, but they do it in silence. Finally, there is the time inversion. When you are just starting out, trading time for money makes sense. Work harder, get paid more. But there comes a point where the math completely flips. This equation shows the tipping point. A $5 million portfolio returning 5% a year generates $250,000 annually. Broken down, that equals $684 every single day, arriving whether you show up to an office, take a vacation, or simply sleep in. However, high earners are hardwired to keep grinding. They work 80-hour weeks as if hourly output is their greatest asset, ignoring their compounding engine. Generational wealth grows through the correction of these small, invisible leaks. It is built by those who realize the ultimate metric of success is the freedom to reclaim your time.